I think we're good to go. All right. Good morning, afternoon, or evening, all. Thanks for joining us today on Stable Stories. Stable Stories is a video series that explores the behind-the-scenes experiences, learnings, and insights of builders pioneering in the stablecoin industry. Today, we have Marcel Kasumovich. He is the chief strategist at Coinbase Asset Management. Very excited about this episode. Thank you for joining, Marcel. How you doing?
Great. Happy to be here. Thanks for having me.
For sure. And Marcel is a fellow Canuck, so this episode is going to be very polite, I guess.
Lots of stories.
Yeah, lots of stories. I love it. Cool. Let's jump right in. So it's a perennial question on all these episodes to sort of like get the guest background, talk a little bit about your journey into crypto. You actually come from a traditional finance background, so you made the leap early. I'd love to know more about how you first explored crypto, got into it, and what led you here.
Yeah, look, I tackle it from a macro lens. So I have a combination of macro hedge fund, banking, and policy. So I tackle it completely from a macro lens. So it's very different from the convention. And at the time I started looking at this stuff, my peer group was like, "What are you doing? This is a complete waste of time." So I didn't really have a big peer group to discuss it with. So I just kept digging in and playing around and trying to understand how it all worked. Honestly, took me 5 years to get comfortable with Bitcoin. And then when I came up for air, I'm like, what are all these other things? How am I going to think about Bitcoin's just given birth to this industry? What are all these other things? And so that was quite interesting. But yeah, it's been a really fun journey. And the stablecoin side was kind of interesting because obviously you had this underlying thesis with Bitcoin, which was not explicitly a dollar alternative, but definitely an alternative monetary policy. It's like, let's go back to rules-based policy. And now that AI is emerging as rules-based, blah, 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 it's very interesting. But when you think of stablecoins as the only, for an extended period of time, was the only killer application. And it became your banking app. So I tackled all this stuff through that lens, and how I ultimately learned about these things was by doing. And I magically turned I'll forget the numbers, but let's call it $1,000 into like $0 in a blink of an eye by moving from ETH to Tether back to ETH to do a deal. And I'm like, well, that was fast. So, but you know what? It's you get engaged, and that's how you learn. It was a lot of fun.
Yeah, it's like how do you make $1 million in crypto? You start with 2 million. Yeah, I've done that as well. That's really interesting. Like you're part of a very early adopter cohort from sort of the traditional financial world who made the jump early. You think about like Saylor, Raoul Paul, guys who have traditional backgrounds that saw the opportunity, made the jump, and it seems like there's a new cohort of people moving into the space from the same industry. And I'm just wondering what your take is on like similarities, differences between the personality types, the groups of people, maybe the impetus for doing it. How are you seeing that sort of manifest, over the last couple of years?
Yeah, look, I think the older traditional cohort typically tackled things from a macro financial lens, and they're probably way too early. I would say in my case, for example, I wrote a big piece in 2020 on it was a modest piece in 2020 on stablecoins that people could digest, people in my community could digest. And I thought we were at the inflection point of stablecoins going full institutional. I'm like, okay, it's here. I mean, way early, right? Just way too early. And I've mapped it out, and I was very proud of the piece. And I'm like, just too early. So being too early is wrong. So I think you had this cohort of traditional people who looked at the world through a macro lens. They saw where policy was headed. They saw the debt dynamics, and they said, okay, how do we think about this complex? And Bitcoin quickly was understood as some form of digital gold. And I think of it as just purely the pristine unit of collateral in the digital ecosystem. And then when it starts to move, then you get a cohort of people that believe it's happening, right? Bitcoin is a sucking sound, and we're going to go to this Bitcoin nation and da-da. which also didn't seem quite right, but it was consistent with the price action. So there was a new cohort that focused on that side, and the original cohort was probably a little more patient. And look, now we're gone full institutional. I mean, if you think of where IBIT has taken this thing, Bitcoin is on institutional rails, and I'm sure for some of the original Bitcoiners in the system, that's quite frustrating, because you've essentially centralized this protocol in some ways, and it's turned in as a use case to something you buy and stuff under your mattress, which you could do a lot more, but that the use case is kind of narrowed to that point of view for the time being. So it is interesting to see the institutionalization of the asset as an investment tool.
Definitely. And has your core thesis on Bitcoin changed at all since you got in? Like, does essentially?
It has. Yeah, it has. You know, I thought of it. I think of it now. So as it got institutional, I said, okay, what's a framework for how an institution is going to look at this? Store value. So we wrote a big paper on how do you think about store value from a capital market asset assumption stuff, really like dry stuff. But every institution needs a framework for being able to reference to say, here's how Bitcoin fits into my portfolio process. So we created a store value index that has both gold and Bitcoin. We run all these simulations, these macro simulations, and we come up with numbers. So that's kind of how I articulate it today. I'm a little bit surprised that as a technology, it's not more utilized. I was super excited about Taproot, super excited about stablecoins migrating to the Bitcoin protocol. I'm like, look, you have this base layer that's probably the most secure base layer we'll ever create. And what are we doing with it? We're just buying Bitcoin and stuffing it under the mattress. That's fine. So that's the collateral argument. Like, it go to $1 million on that, but it can do so much more. So I guess on that side, it's not that I've given up that it can do so much more. It's that you look out the window and you have institutions just racing to Ethereum, and they're like, look, it has a track record. It has an institutional team now, and we can build on it. We build our layer 2s on it, and you're just, the masses are kind of converging to that as your centerpiece for the future of finance. So it's I didn't see that. I have to say I'm surprised we're there, but you know, Bitcoin still has a massive role. Obviously, you see it in valuations, a massive role to play in the new digital economy.
Definitely. For what it's worth, I think you might just be early again. I definitely I personally, from my armchair, definitely do see the end state being more akin to what you had expected in the first instance, and this being a necessary transitional phase. But then again,
well, here,
what do I know?
I'll give you the wildest thesis that I haven't probably articulated it to anyone as an end game, because it's not quite fleshed out. But if we say that the next frontier of markets is space, data centers are going to be up there, which Bezos is now referencing. You've got satellites, blah, 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 blah. Those are naturally going to integrate into digital rails, right? So they're going to run on blockchains, because it's just how else you're going to do value transfer in space. It's just a natural way to do things. It's going to be bot to bot, blah, blah, blah. So then I look at that and I'm like, okay, so now crypto moves to space, right? And then you think, well, what does that mean for Bitcoin? Well, the simplest way to run crypto protocols from space is proof of stake. So I'm like, so maybe Ethereum ends up just being like a test net for the future of Bitcoin. The same way that Ethereum went from a proof of work to a proof of stake, Bitcoin's like, you know what? We're at the tail of mining. Nobody really wants to do it anymore. To hell with it. Just build the parallel. Just follow what Ethereum did, and then you can realize a broader potential. And then those two kind of merge into a singular base layer. I think that I'm way too early on that. I don't even know if I buy the thesis, which is why I don't articulate it. But when I think of the long term, I mean, that's way too early.
Yeah. I mean, I could see it. It's interesting. So humanity is a bootloader for AI, and Ethereum is a bootloader for proof of stake Bitcoin in space. I like it.
Yeah.
We'll get there.
There you go. Maybe.
Cool. All right. Let's talk about a little bit of macro stablecoin stuff. I really would be interested in your take I watched you were in another interview a while back, and you were talking about U.S. regulatory oversteering as a response to FTX, Luna collapse, and the protections that were put in place, whether well-meaning or otherwise. And I'm wondering what you're seeing now on the regulatory landscape, especially in the U.S. Is this genius clarity coming down the pike?
Yep.
Is this like a reversion to the mean, or is it oversteering in the other direction? And what are the implications of that? Either way.
People like to call it regulatory clarity. I think it's regulatory certainty. So what can happen without it's not even clear to me you need these pieces of legislation to carry on. You just need interpretations of existing legislation. So why bother? Well, obviously it's a different asset class. People think of it differently. So let's just codify the rules so that independent of the administration and independent of who's running the SEC or whatever it may be, we're going to codify the rules so that everybody knows what the playing field is. And if you want to change the rules, you're going to have to lobby Congress. And that's very hard. Is this going to be worth lobbying Congress against? No. So genius, I thought, was, look, it's always hard to get new legislation passed, but it was a fairly easy step in the grander schemes because there was already unified support for it. So now we know what a stablecoin is in the United States. Great. So now all of a sudden Tether's going to have a US version of stablecoin. Great. And when the Clarity Act comes forward, you're going to have all these market participants that now know exactly what they can trade, when they can trade it, how they can hold it, what services they can offer. There's just going to be an absolute flood. And call it tokenization. I think of it as more natively digital assets. There's just going to be a flood of migration to these protocols. So I think it's an absolutely massive step for the U.S. to bring regulatory certainty to the table. And you'll probably get the CFTC and SEC to merge at some point. They're already cooperating clearly, and they're already interpreting existing law differently than the previous SEC. So I think I think you just have this pipeline of super interesting activity in real world stuff and then digital and traditional converge, right? And we end up with singularity of markets, which is great.
And yeah, I think that's totally right. And when that happens, looking at the way different states have reacted to financial stressors, and the way their populations have reacted to those same financial stressors, it's very clear that crypto rails, crypto tools provide this toolkit for populations to address things like inflation or demonetization in ways that maybe are challenging to the state in terms of maintaining monetary sovereignty. Do you think that the average state has the capability or the means to address their own financial problems without losing control of the necessary monetary sovereignty for their populations?
I think it's the right question. I think it kind of redefines how we're going to look at the monetary future. And the way I like to oversimplify it, we've had a multi-decade period of discretionary policy that we're now realizing didn't go so great. And we can do all sorts of things to play around with generate short-term growth bursts and da-da-da. But the one thing you can't really ever play around with and you can't hide is balance sheet. So that's where the government debt issue keeps coming out. So you do all these things, but if in the end they're not value creating, you'll see it in the balance sheet. You're just going to have this rising debt burden that has to be shared with future generations. So when you think of the solution to that problem is austerity. So then what's on the other? So, and now that's just exactly what we're seeing now in markets, right? Mm-hmm. Gold is rising a ton. Bitcoin is rising a ton. They're rising against the backdrop of higher real interest rates, which they shouldn't be doing. If real interest rates were higher and you believed everything was great, you would reallocate to the risk-free bonds that are offering you these high returns. They're not doing that. It's the reverse. They're saying we need safe haven assets. What are they? Swiss franc, gold, Bitcoin, maybe stocks to some degree. So there'll be a day of reckoning, some nominal reset, some, be it a Mar-a-Lago Accord, something is going to happen to just codify a cleansing of these imbalances. And then what's on the other side? Well, on the other side, you have to have a new nominal anchor because you've now lost credibility. So pick your nominal anchor. Is it going to be a combination? Is it going to be some rules-based version of targeting gold and Bitcoin? Is it going to be? It has to be something credible. So you end up reverting to a more rules-based policy. Well, then you think, well, big picture, what's AI? It's rules-based. What's Bitcoin? It's rules-based. So all of a sudden, where you can substitute discretion with rules and generate better outcomes, you're going to do that. So I would guess, conceptually, Bitcoin is rules-based monetary policy. Ethereum is rules-based monetary policy, more dynamic, but still rules-based. So I think where we end up is on the other side of this adjustment that we're going through now is some form of rules-based policy that's going to be super simple to understand, because that's our only choice, really.
Yeah, I think that's right. Like, double clicking a little bit into that. What do you see the transition looking like? Do you see it like being able to navigate that uncertain period relatively smoothly with a combination of like stablecoins, CBDCs, Bitcoin, or do you see it more of a forced evolution?
I mean, if we look at crypto adoption, and I'm going to push the US aside, crypto adoption in the US has just exploded because of IBIT. So, but when we look at crypto adoption outside of that, it's all emerging markets.
Mm-hmm. Yeah.
Right. So, Turkey has gone through a systematic nominal devaluation over the course of the past decade. So guess what? Crypto adoption there is enormous, right? They're reverting to some rules-based nominal anchor. Now they think it's the dollar, right? And today it is, and it may stay the dollar. The dollar can go down a lot, and it remains the dollar. And policy can recalibrate to rules-based, and the dollar can still win the day. That's entirely consistent. But the switching costs, when you own a dollar stablecoin versus say a gold stablecoin, the switching costs are very low. So the U.S. has to be really careful. They're in this massively advantageous position, but it could be players in Turkey look at the system and they say, you know what, we've got the wrong anchor. We're anchoring to the dollar, which is great against Turkey, but it's awful against everything else. Let's re-anchor to Bitcoin or gold or some combination thereof. So, but that transition, I mean, I like to say, I have a fun saying, we're poorer than we think, but we're richer for the experience. That's what nominal illusion is. Stocks go up, and I'm like, yeah, but they're all underperforming gold, and gold is the least productive investment you could possibly make. Like it's value destruction, taking it out of the ground, making it impure, and stuffing it back in the ground, and that's the best performing asset. So
that's a great way to put it.
You got to benchmark to something, right?
Yeah.
If you just benchmark to an inflationary environment, deflating fiat currencies, you're benchmarking to the wrong thing. So that's nominal illusion. Emerging market people get that. That's why you see crypto adoption so high. Developed market people, not so much, right? So is that shifting? It's shifting. You see it. You see, like the Citadels of the world, the JP Morgans of the world are now observing this. And they're like, look, it's not healthy for gold to be leading the charge like this for multi-years. This isn't new, right? This has been going on for a while. Same thing with Bitcoin. I mean, the combination of those two, if you have those two as your core anchors to your portfolio, you've been great. So, but the transition is going to be hard. There's no avoiding it. You don't have enough adoption at the people level to be insulated from the degree of the shock that we're living through.
Yeah. I'd imagine the same thing. In the same vein, in terms of, governments and institutional responses, one of the other big challenges is that I see coming is this idea that governments and central banks are more than likely going to have to be domestically competitive with the US dollar in their own markets. over a relatively short period of time, right?
Yep.
And I'm wondering what you think that is going to look like, because there's also, it would occur to me that there's probably a lot of advantage for early adoption of US dollars into domestic markets, right? And incentives that will probably come into play there. But at the same time, there's sacrifice of certain certain monetary levers that may be a challenge. So yeah, just wondering what you see playing out there.
The framework I would have in mind is kind of separated by retail, wholesale, and kind of investments. So if you invest globally, you're probably getting reported in dollars no matter where you are, right? So that's already kind of the numeraire. Wholesale trade, so mostly dollars, right? Now on the retail side, the access to the dollar just becomes a lot easier. So now all of a sudden retail can be far more active or engaged from an investment perspective, whatever it may be, but they can be more engaged, which obviously pressures the local authorities. But at the end of the day, I don't think any country is going to give up on their sovereignty in terms of local currency. And most critically, you're taxed in local currency. So they're like, as long as they can see what you've got, if the value of what you're holding is going up a lot, they could just tax it. So in that sense, right, because you're taxing it in what? You're taxing it in local currency. So I think local currency sovereignty, I still think, is going to be critical. So the competition. So then you have one of two options as a nation state. You could be like, okay, we're gonna have a new monetary order, and we're all going to hold hands, and we're all going to follow this new monetary order. And I think that's where we're headed. I think that's where we're transitioning to. And you can get ahead of it in the transition to say, okay, we just want to get it right now. Let's say that's what Switzerland's trying to do. And then you've got others who are like, look, nobody cares about debt right now, so we're just gonna keep pushing until we have to stop. That's where France is. France austerity is so far off the table. So every country is going to respond differently, but for retail, there's still going to be this local currency component that they're not going to be able to avoid. And then the critical thing is if some country is pursuing a systematic devaluation strategy a la Turkey, they're just going to tax you in local currency. So as long as they have visibility on what you hold, and you're going to see this theme come up over and over. This is the whole thing, anonymity versus privacy. Privacy, people are okay with. Anonymity, they're like, whoa. How do we know what you hold? How are we going to know how to tax you, right? So it's so we have to be careful. Like some of the arguments with Bitcoin, this comes up. If I own a bunch of Bitcoin and it triples in value because of some nominal devaluation, I'm paying local tax on that. I'm fortunate to be in the UAE, so tax rates are favorable. But as a general matter, you're paying local tax on that. So they haven't really lost control completely of the system in that sense. So it'll be every country is going to be able to pursue it a little bit differently. Yeah.
Okay. That makes sense. And how do you see CBDCs fitting into like the toolkit for governments, specifically because you mentioned retail and wholesale, and it seems as though, like from the little bit of research I've done, the wholesale experiments are going very well because everybody wants them to work. All the players,
right.
And almost to, I think there's been about 15 or 20 of them so far. The retail experiments have been abysmal failures. Well, maybe not abysmal, may not be fair, but they have not gone well because the test populations have roundly rejected them, right? Yeah. Is there a path to having a retail CBDC? Is there a path to success? Or what do they look like in relation to stablecoins, and how do they work together?
So the short answer would be no, but I'll expand on it. Look, I have great respect, even when they're wrong, of central bankers. They want to do the right thing as a general matter, I think, and they're trying to do the right thing. And I don't know how we get into these doom loops of, let's run another stochastic dynamic general equilibrium model to figure out what the next 10th percentage point is going to be on inflation in 14 years time. I mean, I don't value those exercises at all. So I don't know how we get there, but as a general matter, I think they've got the right intent, but they're not innovators, right? They're takers on this stuff. They're not innovators. So Stablecoin have won the day. Stablecoin has stood up and said, hey, we're the narrow bank, and we're privately funded, and We've demonstrated safety. I mean, you put the crypto universe through a GFC that was cleansed in like 3 minutes. We're still cleansing the GFC, for crying out loud. We still have residual hangover from the GFC. Like, what do we do with Fannie and Freddie, right? Crypto cleansed their GFC in 13 minutes. It's like, okay, we're done. And then the thing.
It was a painful 13 minutes.
It was a very painful 13 minutes. Let me tell you, in more ways than one. But it's true. It's true. But then the interesting thing is what survives, because what did they do? They just called it. They're like, oh, Terra Luna doesn't work out. It turns out there's circular logic that made it implausible to be successful over a long time. Yeah, we're just going to make that a zero. It was $60 billion for crying out loud. It wasn't nothing. So we're just going to make that a zero. Okay, next. So you distribute loss immediately to the people that it should be distributed to. Super efficient, right? And then what I think was missed in that, the stuff that makes it through a GFC is extra resilient, right? It's like, I run a stablecoin and we were fine. I run Ethereum and we had no shutdown. I run Bitcoin, no shutdown. So it's like, oh, wait a minute, that's amazing. You can survive all of that with no stoppage. Wow.
With no circuit breakers.
I looked at it and I'm amazing. No. So I'm like, okay. So when I look at elements like that, my kind of great lessons. Now, relate it back to CBDCs. Central banks can't lead on this side, but they can follow, right? So every central bank is going to have a CBDC for the same reasons I've observed previously. I think you're not going to relinquish your monetary sovereignty. There's going to be an option. Now, here's where it gets tricky, and it's a super simple point, but it's been overlooked. Let's imagine you have a retail CBDC. Which means the same with cash. On demand, the central bank satisfies your cash needs. That's exactly how it works today. They're like, at the prevailing interest rate, if you want more money, go get more money, and we'll print it to make sure you have it. And right now in the US, it's about $2 trillion floating around the system, right? Think of it in the CBDC context. Carrying around cash is difficult. If you have if you want to carry around $100 million in cash because you're afraid of the banking system, you need a security team. So you're not going to do that. You're going to buy something else or whatever it may be. Well, with CBDCs, imagine there's a bank run, and I'm a depositor at a big bank, and yeah, I think the bank's going to be fine, but I'm now a creditor to the bank, so it's their obligation. But they said, "Don't worry, we'll give you the money back," and they're levered. And then there's the Fed that says, "Well, you could just give us that money, and we'll pay you back." I'm like, who am I going to face? I'm going to face the Fed, right?
Yeah.
So I'm going to take my money out of the commercial bank and go to the Fed for sure. In any hint of crisis, and they have to accommodate it. So that's a source of financial instability, ironically. So, and the Fed doesn't want to do that because you run the risk. If they do it today, no one's going to care. No one's going to pay attention. But the minute that there's a fracture in the banking system of any sort, you're just going to be a mad dash, which can be done 24/7, 365 with a click of a button. You don't have to go to the bank and get a bunch of cash and wheelbarrow it out to your car. You don't need a security team. It's just you're going to go to your wallet and just make the transfer. So then how do you deal with that? Well, you cap CBDCs. So you say, okay, we're going to have a CBDC and you can use it to buy bubble gum, but you can't have more than $100, right? Well, then what's the point? You know what I mean?
Yeah.
Then it's just an option. Then you just have it there just in case. So it's going to be this just in case thing, which is smart. And then I think the things that they're going to struggle with, and they're going to fight through it, privacy versus anonymity, right? So you think of it, there's legislation in the US that we're going to make CBDCs impossible to create. I'm like, well, that might be a step too far. You can make them private, right? We now have technology through ZK, zero knowledge proofs and things like that, where they won't know who you are unless they have the right by way of law to figure out who you are. Otherwise, you're a free citizen. So there's things like that they can utilize to still have a CBDC and maintain privacy of your transactions, which I think is where we end up. But it's going to be a footnote in the global system.
Yeah. So I think I tracked most of your thought. I have one question on it. You kind of mentioned that the solve to insulate commercial banks from a potential bank run is limited balance, like basically capping the amount that a person could hold at a given time. So like what is the function then of even having a retail CBDC? Like again, the wholesales kind of makes sense to me, but like what is the purpose then? Is it for daily spend or what's the benefit?
Just daily spend, but chiefly optionality. You know, it's that we don't know what the future holds. So we're just we're gonna mirror the rails. So we're participating in the rails just to have optionality. Now think of it from a practical perspective. You could even go one step further of how irrelevant. So it's really irrelevant. It's more of an academic exercise that keeps optionality open because we don't know what the future holds. But think of it even one step further. So right now there's $2 trillion of cash, US dollar cash floating around. And a lot of bad guys hold that stuff too, by the way. That's what they use it for, like drug deals and all this stuff. They ain't using crypto. I mean, it's cash.
Nobody wants to talk about that. Yeah,
exactly. Exactly. It's very interesting. You know, it's like, oh, we have one illicit transaction, and you know, it's anyways. So that now, so you have that cash. Now, what happens when we move to 24/7, 365, blah, 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 all these great things that people talk about, the innovation? The velocity of money goes up a lot, right? Because now all of a sudden, what's the cash buffer that Dave needs to hold? It's very small, right? Because now you can look out the window and be like, oh, I have this cash coming in at this time for sure. I know it's coming. And I have this cash coming in and this investment's maturing. And so you're gonna have way better clarity on the cash, on your cash incoming and outflowing. So then the cash buffer you need to hold to make sure those two align is much smaller. Well, that's true for everyone. So how much cash do you need in the system? Bad guys aren't going to use this. They're like, well, I'm not using CBDC. We have these ZKs, but I'm a bad guy. They're going to figure out I'm a bad guy, and then they're going to have my entire transaction history. So I'm not using it. And so then cash holdings or the CBDC cash that you need to make the system go goes way down. So not only is it not relevant from a broader practical perspective, even wholesale, I don't think it's going to be particularly relevant. But from a pragmatic perspective, the innovation means there's going to be much less of it as well. So then central banks, now think of it from a central banking perspective. They got $2 trillion that they paid no interest on to buy a bunch of bonds. So that number is going down. So then what do? Do you sell down your bonds? Do you create more excess reserves in the banking system? So they're going to have to think about all of this stuff very carefully. So all that tells me it's slow and irrelevant. I mean, it's if I were to central bank, it's what I would want to work on because at least you're learning. But I just don't see it being relevant to the global system.
Yeah, interesting. But you said that in a much more intelligent way than I would have, but I tend to agree. Yeah, awesome. So the next one is kind of tied to this. There's this Cambrian explosion of stablecoins being issued, new stable layer ones being spun up, CBDCs being implemented, and everyone is sort of like coalesced around this idea of stablecoins being crypto's first killer use case. But on the other side of the coin, fragmentation is like the number one, concern within that meta, right? And a lot of the developments that are happening right now seem to be making the problem potentially worse rather than better, right? And I'm wondering what your take is on the long-term outlook for stable coins and adoption. Do we end up in this like new colonial script type environment, or is it a winner take most? Or is the problem solved at the UX end where it gets abstracted away enough that people are interacting with a ton of chains and tokens, but they're not seeing it under the hood?
I think the question is so good that you have a lot of answers embedded in the question, which is awesome.
Yeah, so I didn't mean to throw too much.
No, it's great. No, it's great. It's great, really. I mean, look, the user experience, I think, is going to be the critical factor. No one's going to know they're using crypto. They're just going to want the user experience. But I think, look, we're going to get all this experimentation. And I think it's amazing that we're going to this narrow banking concept. Because think of what a stablecoin is. If you own it, it's 100% reserved. So yeah, there's a tiny duration mismatch, but it's 100% reserved. And once the stablecoin issuers are holding natively digital paper, which is coming, then not only is it fully reserved, but it's going to be fully transparent in real time. we're going to be able to go on Dune Analytics, hit a go button, and we're going to see exactly what Tether and Circle and all these characters hold. So you're going to know it's fully reserved. Well, once that happens, it kind of gets commoditized. No, it's not super exciting. So where I think people get a little bit twisted on this, it as a payment technology, amazing. But from a size perspective, again, go back to the point on velocity. It's so efficient. The velocity is so high. Like Tether turns over once a day. The velocity 365, just unfathomable numbers compared to fiat. Fiat turns over 4 times a year, and Tether's turning over once a day. And that's not because people are they're just punting it around. It doesn't move, right? It's just they're moving the collateral around. So it's just hyper efficient. Well, with that kind of velocity, you need much less of it to support transactions, which means what? If I hold a non-yielding stablecoin, and I just take that as given, we can fight about whether it should be non-yielding. I'm like, let's just leave that. Let's just park it. It's a commodity, non-yielding. So I've got this non-yielding thing called stablecoin, and then I have this proliferation of yielding money funds that are also on digital rails when BIDL comes onshore in the US. I'm just going to write an algo to sweep my excess cash into a money fund to collect the yield. And we're going to call that a security because that's what we call these things. So how big are stablecoins really going to be? The universe of stables and money funds can grow massively because you're introducing new markets to the dollar. So that can happen. But maybe stablecoins isn't really the vessel, right? Maybe stablecoins just super commoditized. And then the investment side, what you do with the stablecoin is what you want to think about the value chain, right? So the idea of I'm going to create a layer 1 for my stable and data. I mean, I think it's a step back personally compared to building a layer 2 on top of some base layer. You're kind of building a moat. I understand why people do it. I understand why they get excited about it, but it strikes me that that's not how you're going to win the day. So it's worth a shot, I would say, because it could happen. Seems unlikely to me. And then for the user, you're just going to make sure all these things are fungible to the point where you don't even care. As long as we have the clarity that these are truly fully reserved banks, you don't even care what those units are. So highly commoditized. And I think that happens pretty quickly, right? They've been around for a while. So this I think happens pretty quickly. It's not to lessen the innovation, by the way, because as a killer app, I mean, look, again, getting through crypto winter in a resilient manner, like critical. If a stable coin, a boring stable coin didn't make it through that period, it would be a problem. And that they did meant that the people who were using it felt comfortable, felt safe with it. And now it's just going to integrate into PayPal. It's going to integrate into everything we do. Yeah, still super exciting tech. But I think the story in terms of how it's integrated into the mainstream is going to be a little bit more investment focused, like what we use the stablecoin for, rather than stablecoins themselves.
Especially the early adopters. I think as soon as it becomes feasible to generate yield on smaller balances or move things across into yield,
100%.
And I also think that like long term, the outcome, like it makes sense that it collapses into a little more uniformity, but like short term, the opportunity to generate yield off of large networks or existing user bases or TVL, like it's too hard for businesses, for banks to pass up. So I feel like we walk through this muddy water of everyone issuing stable coins for a little while before we
I agree.
Something a little more stable.
And the data oracle guys are going to love it because they want multi-chains. They want everything, because then you need a data oracle to make sense of it all. So they're going to love that stuff. And then look, your observation on small yield, I think of it as micro yield, micro payments, all of that stuff. People don't even talk about this stuff yet. I mean, you think of what an advertiser does. So I'm going to throw up a big picture of LeBron James, or LeBron James is going to have a big announcement where I drink this whiskey or whatever cognac, right? Now everyone's
Yeah.
going to buy the cognac because they love the. I'm like, okay, so they're going to pay him a ton of money because they're and they have no idea, but their best guess is that him representing the brand is going to generate all these new buyers, maybe, but in the distant, maybe not too distant future, if at the micro level, if I'm walking around with a Nike hat or whatever it may be, there's going to be a chip on this hat that says, hey, you're wearing the Nike hat. You're around 20,000 people. If you're hanging around 20,000 people with that hat on, we're going to pay you a bit of money.
Yeah.
And all of a sudden people are like, wait a minute, like I wear Nike. Nike's really, so you're going to see a massive shift of advertising dollars away from a single person where the ROI is completely unclear to, hey, just wear our stuff and we're going to pay you. We're going to pay you a little bit, you know?
Yeah.
And you're going to, it's all going to go to your wallet and stablecoin. And then you're just going to have a little algo that says, hey, once I have $1, move it over to this money fund. And what do they care? The dollar transfer cost is zero. The cost of fractionalizing the interest is zero. All this stuff. So the marginal cost of finance goes to zero. So, I mean, there's a billion different things that are going to come that we should think about. We should foresee and talk about them because they're going to happen. And you think about them now, and I'm going to be horribly wrong on 90% of it, probably right on 10. And I'm going to hang on to that 10.
Yeah.
So you got to guess. You got to guess as to where it's going. Like maybe everyone does still pay LeBron James for this stuff. I highly doubt it. It's way more effective.
Yeah, I think you're totally right. And when you think about like the innovation that's happening in terms of like social creator incentives, like Base is pushing really hard for it. Like everyone is sort of like driving at trying to create this like everything app experience, right? OpenAI, Base, X is kind of headed in the same direction, Facebook even. But if you take that like that idea of direct to consumer branding incentives and layer on social media on top of that and token design around gating and communities and revenue generation models, like it's absolutely staggering. And
I'm
like
with you. I mean,
and a lot of fun. It'll be a lot of fun.
It is.
Yeah.
You look, this is where I try to convince people. I'm like, think of everything you're doing and think of your content. Like, don't think of having a job. Don't think of, what's my next pay. Think of the content you produce. And those who produce great content, and we could debate as to what great, who decides great content? The market.
Yeah.
If the market likes, I don't know, fart jokes and fart coin, the market wins. I mean, that's what they want. And you may not.
I think the market has resoundingly said that it does in fact like fart jokes, fart coin.
Right. So it's like the market will decide. So it's, you may think your content, I'm sure on the transition away from poets speaking in New York City to the amplifier and the guitar and poetry turning into song. I'm sure that was very painful for the pure poet, right? But it is what it is. Dylan Thomas just didn't have a leg to stand on anymore because everybody wanted to hear the singer. They're like, we kind of like this better. And you can always lament the loss of the horse and buggy, but we keep moving forward, man. So I think this is going to be super. It's way broader than people appreciate. And then you think of it. I understand the worry with AI. I totally get it narrowly. People that don't think of what they produce as useful are really worried. And I'm like, so just change your mindset. Like, think of the things you do that are useful, and then you're going to monetize that content. And it's going to be through these micropayments and whatever it may be, social networks, and you're going to have a lot of time on your hands because the robots are going to be doing everything. So start thinking about content, and it'll all work out.
That's a whole other podcast that me and you could spend a couple hours on that one because I have some thoughts on that. Because I think you're totally right. And I think that the problem that's like being covered in some places, but isn't really being thought of as like the real challenge is the human, like the human attachment to, and the concept of what value actually is. Right. And I think that it's intrinsically tied to a concept of like physical work or the ability to generate revenue. Like when you divorce the concept of value in the outside world to the concept of value internally, you yourself as a person, I think that that's going to be the challenge, right? Because you no longer have to identify yourself by what you do, what you produce. necessarily.
Yeah,
right.
totally.
And that's going to be
totally.
sort
You're
of
just going to have to change your perspective on all.
You're going
and then you just look back in
entirely.
history. It's like farmers hated
Mhm.
books. It's
Yeah.
not that they hated books. They thought that if you were reading books, they weren't going to be able to feed people. They're like, put the books down. We got stuff to do here, people. And there was
Yeah.
something innate in the child that was like, oh, no. We have a massive revolution that's coming. You're not going to need me to farm anymore. I better start getting smarter about the world.
Yeah.
Not to say that dad wasn't smart, who was farming the field or whatever it may be, but I'm going to have to change the way. It was just this mind shift. And then the old farmer's looking at the kid being like, oh, we're in trouble. If that's the next generation, we're in trouble. We're all going to starve.
And that's what every generation says. Like that's
Every
literally
generation.
what every generation says.
Every
that
generation.
Somehow the
right?
kids are all right. Yeah.
And this is where with stuff, even with stuff like, okay, we're going through a very difficult period for macro dynamics and all these things. Okay, we've lived through worse. It's going to be fine. We're all going to be a bit poor. Just deal with it. It's going to be fine.
Yeah.
The future is bright. It's always bright. And you think now
we're all a little bit poorer,
brighter than ever.
Yeah,
exactly. We're all going to be. Maybe communities will be a little bit tighter. We'll be a little more friendly to our neighbor. As opposed to we're fretting as to what car they're driving and what car I'm driving. I don't have a car, so that's easy. But you know what I mean. Yeah.
Nice. Hey, you remember when this podcast was about stablecoins?
We crushed the stablecoin side. Crushed it.
That was awesome.
Well, we're going to use stablecoin to do all this stuff, right?
We are, yeah, or Bitcoin eventually if the thesis plays out.
Yeah,
right.
Yeah.
In space.
Yeah, in space. Yeah. So it's that's it.
Yeah, I like it. I've got two more quick ones, totally open-ended. Gray swans next 12, 24 months. What don't we know that we don't know? I guess that would be a black swan. What do we know? What don't we know that we may not suspect? Surprises you think are coming down the pike in the next little bit, either positive or negative. But anything contrarian?
Might not be contrarian. Look, I think on the Bitcoin side, it's maybe a bit too micro, but in the very short term, I think this Knots core battle, I think it's relevant. Look, anytime you have the community being pulled in different directions, we saw it with Bitcoin, in the 2010s. That I think it's just important to appreciate both perspectives on where they're pushing, just in case there's a fork. Because where I think it's really important is what people will go back to is they'll say, if you own Bitcoin, whatever and there's a fork, whatever that new Bitcoin is, you're still entitled to the forked asset. Well, if you're operating in an ETF in a grantor trust, you're probably not entitled to that forked asset, right? So now all of a sudden the people that hold the underlying are like, oh, wait, I just got a gift that these folks don't get. And by them not getting it, my gift just went up in value. Thank you very much. So I think that's an important one. I think we have central banks that are the most important one, which is a kind of a known unknown. Central banks are hoovering up gold. This is crystal clear. It's only a matter of time before Bitcoin enters that equation. So right now, Bitcoin is a reserve asset for the private sector. When does it become a reserve asset for the public sector? If you can figure out that dynamic, you're miles ahead of the curve, And we know that the U.S. has this on the radar. It's kind of fallen to the back burner a bit, so people have forgotten about it, but it's going to come back. And we have to remember that as gold goes up in value, those who hold gold now want to rebalance into other stuff, right? And they don't have to rebalance by selling gold. They could just borrow against it the same way people do against Bitcoin to do other things, to rebalance their portfolio. So I think that migration of Bitcoin to a reserve asset for the private sector to also be for the public sector, recognizing that it's a critical piece of collateral for the digital future, I think that's a big one as well.
Cool. Yeah. I look forward to that when there's gold, there's increased gold and Bitcoin on the balance sheet of central banks. I like it. Last one before we close out. In addition to being a very deep TradFi degen, which is a great combination, you're also an avid runner. You've done marathons. You're big into that. If you had to compare a career in crypto, your experience in crypto, 100-meter dash, marathon, ultra marathon. What would you say?
Ultra marathon, but then you watch the way the Kenyans and Ethiopians run these things. That's my 100-meter dash pace. so you have to be fit enough to run an ultra marathon as though you're running a pretty decent 100-meter dash, just perpetually. But I do think it's look, the changes are just going to be so dramatic and there's going to be so many twists and turns and bumps and all of these things. I think it's just really important to recognize that this stuff is here forever. So don't worry, don't oversteer the next, 10 basis points, or in vol terms, 10 percentage points in Bitcoin or Ethereum or whatever it may be. Just really keep an eye on what your framework is for understanding the fundamental value of these things. And that to me is much more ultra marathon, and you just have to be zen about it.
That's a good way to put it. Like this industry, 3 months is essentially an eternity. So it'll be very interesting to see if crypto starts operating on slightly more reasonable timelines of the rest of the world, or if we end up pulling the rest of the world into our timeline and things just get even crazier.
Well, look, think of what investment is. So old school investors are really frustrated because they're like, I look for value, I buy it, and it goes up, and I make a lot of money. Value is getting absolutely destroyed. And then they say, well, the only time that happens is when there's massive bubbles, so we're in a massive bubble. And it's like, well, for sure, there's bubbles going on. But the NASDAQ bubble of the 90s, gold was down, and it was in the 200s, 300s. I mean, it's not that we had this broader inflationary asset story. So it's very different. And the underlying for the bubbles now are real things: power, water, real things. So it'll be a lot of fun to be on this journey to see where we end up on this train, for sure.
Definitely. Well, I think we'll leave it at that. Thank you so much, Marcel, for joining. This has been awesome. It's been a pleasure talking to you.
A lot of fun.
Nice.
Thank you, sir. Yeah.
Cheers. All right. Thanks for joining Stable Stories. Talk again next week. Have a good day, everyone. Cheers.